Let's have a quick conversation about partnership taxes when operating in several states. Okay, let's say you are a partnership right now and you operate in more than 2 states. So in today's conversation, I want to talk about partnership taxes in that context. So here's an overview I want you to pay attention to. The thing here is that business partnerships are often compared to marriages, right? And with good reason, because when you enter one, you're signing up to mingle with finances and also basically your operations, your way of looking at things. And so when we talk about partnership, we're talking about a business coalition, if you will, that is actually shared by multiple owners. So it's not a legal business entity, and it doesn't have to be registered with the state. So basically, if you decide to go in business into business with another person without filing any state paperwork, you are automatically in a partnership. So some types of partnerships are legal business entities registered with the state, right? So these entities may provide a limited liability protection to shield your personal assets in certain cases, but you also have to check with your state authorities to see what kind of a partnership stipulations they have locally. So how are partnerships different from other business entities, you might ask? Well, a partnership, similar to a sole proprietorship, is legally and financially inseparable from its owners, and profits and losses may be passed through to the owner's personal income for tax purposes, and debts and liabilities passed through as well. And partnerships are generally easier and less costly to create than corporations. And the cool thing is that all partnerships provide the advantage of pass-through taxation, which generally results in lower taxes than other business structures, such as corporations, for instance. Okay, so basically, when we talk about partnerships, you have several kinds of partnerships. You have a general partnership, you have limited partnership, you have limited liability partnership, and then you have limited liability limited partnership, so LLP. So basically, you have a series of steps that you need to follow if you are going to think about partnership taxes. So how do you actually legally form a partnership? Well, you have to choose a structure. You have to really draft a partnership agreement. You have to basically, especially this is important for tax purposes, you have to name your business and make sure that it's free of any copyright infringement. You have to register your partnership. You have to submit annual reports, including filing your annual tax reports. By the way, boss, welcome back to the show. It's really a pleasure to have you here. You are going to enjoy today's conversation about partnership taxes when operating in multiple states. So here are the steps I really want you to follow. So the first thing you need to do here is that you need to prepare Form 1065, U.S. Return of Partnership Income. And the good thing is that if you're operating in multiple states, in terms of federal taxes, you only have one federal tax that you have to send. Okay, and so every partnership must prepare a federal partnership tax return on Internal Revenue Service Form 1065. Now, on this form, you'll be asked to provide the partnership's total income or loss. Now, I'm talking about consolidated income or loss. We're speaking about all the loss or income that you actually accumulated from all your operations in all those multiple states. So you will list deductions such as salaries, guaranteed payments to partners, rent, repairs, taxes, depreciation, and employee benefits programs. So your partnership's total income, less its deduction, is normally its ordinary business income. And again, when we analyze the partnership income at the federal level, we don't care if you operate in 10 states or you operate in 40 states or in all 50 states. It's really important to keep that in mind. You also need to fill out several Form 1065 schedules. So Schedule B, for example, includes a series of questions about your partnership, from the types of partners to ownership of corporate shares to types of distributions made. So again, here 1065 goes into through Schedule B goes into granularity to really have a lot more information about the partnership itself. So that's one. You also have another schedule, Schedule K. This is a schedule of income and expenses that forms the basis for the K1 forms you will issue to shareholders, or in this case, when we have a partnership, we're talking about partners. Okay. You also have a Schedule L. This is a balance sheet. Some partnerships are also required to complete schedules M1, M2, and or M3. So this is really important to keep in mind. And the return must be signed by a general partner. Okay. And so when we thought, and it doesn't matter, again, the number of states where the partnership operates doesn't really matter. If you operate in multiple states federally, you only need to file one tax return. And so that's pretty much it. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about partnership taxes when operating in multiple states. Now, the second thing you have to do here is prepare Schedule K1. So partnerships actually are also generally they are required to complete the federal Schedule K1, partners' share of income, deductions, credits, etc. for each person who was a partner at any point during the tax year. So what you want to do here is you want to have a clear idea of your partner roster. So if you have partners in several states, or if the partnership actually operates in multiple states, make sure that you have actually consolidated all information from all those states, including the partners on the ground. Okay, and so any person who was a partner at any point during the tax year, you got to take that into account. So the K1 form lists the partner's name, address, and percentage share of profits, losses, capital, and liabilities. So again, when we talk about the K1 here, this is a federal form, so it doesn't matter if the partner lives in New York or California or Georgia or Alabama. Doesn't really matter. And so the K1 also lists the partner's share of ordinary business income or loss, rental income or loss, and interest income. It also includes the partner's self-employment income, credits, and distributions. Okay, and the cool thing is that basically you need to understand that once you have prepared a Schedule K1, you must send a copy to each partner no later than March 15th. And the cool thing is partners can then use the K1 form to prepare their personal tax returns. And again, partners are filing taxes not only federally on their Form 1040, but also state-wise. So this is where it's really important to pay attention to when you have to send this to them. So you have to send it by March 15th. And the third thing you want to do here is you want to file Form 1065 and copies of the K1 forms. So partnerships, especially those operating in multiple states, actually must file copies of the K1 forms with their Form 1065. And the filing deadline, once again, for Form 1065 is March 15th. So most partnerships can file the forms either electronically or by mail. And the cool thing is if you actually operate in multiple states, it's just better to use the electronic route. It's faster, it's cheaper in some cases, and most importantly, it's more likely to be error-free in the end. The next thing you want to do here is to file state tax returns. This is where it becomes very interesting, because if you are operating in multiple states, that means that your partnership must actually file state taxes in every state, in every jurisdiction where the partnership is active. So if the partnership, let's say, is in 50 states, you may have to file state tax returns for the partnerships in all 50 states if the state so requires. So it's all about the local regulation. So it's important. So your state or states may require partnerships to file a state tax return. So depending on the state, partnerships may be required to pay franchise, excise, or sales taxes. So you can find the tax filing requirements for your state online at its Department of Revenue website. And so this is kind of important. Now, what you want to do here is you want to consolidate everything. So basically, when you actually file all your individual state tax return and you consolidate that the numbers, the data should actually match the form that you are filing with the IRS federally. Okay. And the last thing you want to do here is you want to file personal tax returns. So if you are a general or limited partner, you must report your share of the partnership income or loss on your federal income tax return. And so this doesn't happen. This doesn't matter if the partnership operates in multiple states or if the partnership operates in only one state. In other words, if the partnership is a foreign partnership in several other states, it doesn't really matter. You still have to file your personal tax returns, okay? And you file your state tax returns in the state where you are a resident. So the Schedule K1 you receive from the partnership contains the information you need to do to file your state and federal tax returns. So in addition, if you are a general partner, your partnership income will typically be considered self-employment income. So you will report this on your personal tax forms and calculate self-employment tax using Form SE. Form SE, don't forget that. So because limited partners typically are not involved in running the business, their income is considered passive income. So if the partnership operates at a loss, they can only use that loss to offset other passive income. In addition, one thing I need to say here is that limited partners' income is not considered self-employment income except to the extent that they receive guaranteed payments for services they actually perform for the business partnership, whether the partnership operates in one state or multiple states. So filing partnership taxes, especially for one operating in multiple states, is a multi-step process, and you may want to consult an accountant or invest in tax preparation software to help you complete your returns, okay? This is really important. And to avoid late filing penalties, be sure to comply with federal and state filing deadlines. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about partnership taxes when operating in multiple states. Now, here is the approach I want to share with you here. What are the requirements for LLC partners or a partnership, or let's say LLC partners or even regular partners that they are located in different states? The thing here is that you really need to understand that whether the partners are located in different states or they're in the same state doesn't really matter. Because when forming a partnership, let's say on LLC and LP and LP, whatever, if the partners are located in different states, there are a few requirements that need to be met. But those requirements are basically not really that stringent. Now, the partnership or the LLC, the LP, or the LP must be formed within one state. And it must have a registered agent in each state where the partnership has members or does business. So in every state, so if you are operating in multiple states, aside from taxes, you need to make sure that regulation-wise, you actually comply. So you got to have a registered agent in every state where you conduct business, and the registered agent is responsible for receiving legal and tax documents on behalf of the partnership. Again, the partnership can be an LLC, can be an LP, can be a GP, can be an LP, it can be anything. And so the registered agent is responsible for receiving those legal and tax documents on behalf of the partnership and for forwarding them to the appropriate member. Another important requirement is actually the creating of an operating agreement, which basically outlines the terms and conditions of the LLC's management structure and the rights and responsibilities of each member. So while each state has its laws and requirements for partnership formation, there are a few common elements that all partnerships must adhere to, right? One of the main requirements is filing articles of organization with the state's Secretary of State. This document outlines basic information about the partnership, such as name, purpose, and registered agent. And in addition to filing the articles of organization, partners will also need to decide on who will manage the partnership. General partnership versus limited partnership, okay? So there are two options for management, especially when it comes to LLC, for instance. You have member managed, or you also have manager managed. So this is kind of important, but one thing I want to say here is that when it comes to multi-state LLC formation, or LLC partners will need to research and comply with the specific laws and regulations of each state in which they plan to operate. And this includes obtaining any necessary business licenses and permits, registering the LLC or the partnership for that matter for state taxes, and adhering to state labor laws. And partners need to do their due diligence and seek legal advice to ensure they are meeting all the requirements to operate their partnership in multiple states. One thing I want to say here is that, basically, if you are trying to have a partnership that operates in multiple states, it's pretty cool because you are having the partners that are located in different states, and so those partners can bring expertise, they can bring insights, and they can bring local insights. Okay, and it's also important to understand that when you analyze the pros and cons of a partnership operating in multiple states, especially when you actually analyze this from a tax angle, you have more pros than cons. You have more advantages than the disadvantages. Now, the advantages is that you are able to generate more income. You're able to tap into a local market. You're able to tap into a local expertise. You're able to actually have a more consolidated expertise at the more consolidated strategy at the federal level, but when you at the multi-state level. But the only cons is that there's a lot of paperwork. Now, that paperwork can actually be gone if you use software or if you actually outsource the tax preparation to a third party. So this could be a CPA firm. This could be an enrolled agent that has expertise in all the states where the partnership plans to operate or has already operated during last year. Or you can also reach out to a tax attorney. Some tax attorneys are really good. They have great ideas, and they have those sort of tax law partnerships that allow them to have insights into the partnership laws in every state. So the thing is, you want to make sure that you choose a third party that understands the laws, the state tax laws in the jurisdictions where the partnership operates. But most importantly, whether you go with a tax law software tool, or you actually hire a CPA firm, or you hire a tax attorney to kind of help you out. I mean, you might actually have to hire multiple tax attorneys, multiple CPA firms, but the thing is, once you actually have that resource on your hand, you got to be able to actually direct the resource to the right location. Because if you operate in 5 states, let's say New York, Pennsylvania, Connecticut, New Jersey, and Delaware, for instance, simply having a CPA firms in those states is not going to cut it. You need to really tell them exactly. You need to give them more information about your partnership, how you operate, what kind of income, what kind of income and deductions, what kind of income and expense items you have during the year, and how those items, those transactional items, fit into the different states, the respective states' tax laws and regulations. The thing is, it's really important to understand when we talk about partnership taxes when operating in multiple states, it's really important to pay attention to the deadlines. Because see, every state has its own tax regulations, and we know that federally, you got to file taxes by March 15th. You got to send the forms K1 by March 15th, and you got to send the Form 1065 by April 15th. Okay, March 15th, April 15th. So those dates are known at the federal level, but every state has its own sort of calendar. And depending upon the state and depending upon what kind of calendar they have, they might actually be looking for your partnership to file taxes at a certain date. So it's always important, though, when we talk about sales taxes, I mean, not sales tax, when we talk about state taxes, it's really important to understand that you have a responsibility to file taxes at the state level. Otherwise, you might lose your partnership, you might lose your license. And some states, for instance, when it comes to LLC, they want you to actually file an annual operating report, so they have a clear idea of what's really happening with the organization. Now, if you don't file those operations reports, what will happen here is that you will lose your certificate of good standing. So you're not going to have a good standing certificate, and the Lord knows how important that certificate of good standing is when it comes to getting things like loans, business lines of credit, or in some cases net 30 accounts. So if you're trying to build your business credit, if you're trying to really show up, if you want to really beef up your reputation, it's really important to actually be in good terms with state tax authorities. Otherwise, they're not going to actually issue you the certificate of good standing that you really need. And also, one thing I need to say here is that when we talk about partnership taxes, we're not just talking about income taxes. We're also talking about payroll taxes. We're talking about unemployment. We're talking about FICA, SUDA, FUDA. We're also talking about excise taxes, franchise taxes, and so on and so forth. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about partnership taxes when operating in multiple states. And let's do a quick recap here. So in today's conversation, I spoke to you about the overview, and then I spoke about the steps you need to really take, and also the approach. Thank you so much. God bless you. I'll see you another time. But until then, remember, stay marvelous.